Hey everybody, what's up? Tuesday, September 18th. Yesterday was Monday. I put out the new edition of MMT Trader. If you would like to get a copy of that and also check out the back issues of the report, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. What I do is unique. I have synthesized the concepts of MMT with the trading strategies that I have learned and developed over the last 40 years. I've been a member of 4 exchanges, a floor trader, traded for a hedge fund, ran the proprietary trading desk of a major international bank. So this is a unique service. As I've said many times in the past, there are a lot of MMT theorists out there and academics. I have put together the MMT approach with the trader's mentality and also combine that with the very important concept of mental game. Successful trading is all mental, all right? I could take any system and make money with it. As I've said many times, I could throw darts at a dartboard and make money. It is all in the mental game aspect, and I help people with that on a daily basis. So if you want to check out the report, go to pitbulleconomics.com and sign up for a 30-day free trial. All right, let's get to the markets. Now, for those of you who have been following me for any length of time, if you've been watching these videos, you know that I have been saying that rates are going higher. This was not some guesswork or any kind of predictive forecast. This was based on just pure knowledge of price setting, the fact that the central bank, the Fed, sets rates. It's not the marketplace, it's not the bond market vigilantes, it's not inflation. It has nothing to do with that. Although inflation does influence Fed behavior, but it is all about rate setting by the central bank. And when the central bank is raising rates, you do not want to buy bonds. Bonds are going down, rates are going up. There have been many people and big Wall Street firms who said 3% was going to be the top in 10-year yields. I said, no, that is not correct. 10-year bond yields are going to rise above 3%. Now, it took some time, and we had a number of pullbacks, and we may still have a little pullback, but 10-year yields are going higher simply because the Fed is raising interest rates. And the interesting thing about the Fed's actions is that when they raise rates, it reinforces that cycle for 2 reasons. One is that rate hikes are inflationary because they are price increases. The Fed is actually setting general prices higher when it raises rates because the cost of credit is reflected in the cost of all goods and services, number one. And number two, rate hikes equate to a fiscal expansion. The government is a net payer of interest, so when it hikes rates, it necessarily causes the government to pay more interest, and that flows to income in the economy. And the Fed sees the price pressures increasing. It sees the inflation. It sees the economic pickup from the fiscal expansion. And as all central bankers do, they react to that under their flawed paradigm, thinking that, they have to raise rates some more. And that just keeps the cycle going. The inflation goes higher. The fiscal expansion gets greater. Ultimately, inflation is what stops the economy. But the Fed creates the inflation under a policy which it believes it is curing the inflation, but it is not. And also, as I have said in the past, that rate hikes are bearish for the currency. I mean, we've seen that so very clear in examples from Venezuela to Turkey to Argentina. Argentina's got 60% overnight rates. The peso is the weakest it has ever been. Last week, the Turkish central bank raised rates 6.25% in one shot, where they go from like 18 up to 24. And the Turkish lira rallied briefly. I sold the Turkish lira. It is now down from that point. All right. The rate hikes for the dollar will be no different. It will cause the dollar to go down. And in fact, we are seeing this 95 level on the dollar index, where we have been basically for 4 or 5 months. It is starting to roll over from that. All right. The entire dollar rally, the dollar index rally from 88 up to 95, or I think we hit 96, 98 at the peak. That was a correction in a downward trend in the dollar, which is going to persist for a long, long time. Now, the rate call was something that my subscribers have made very, very good money on. Every time we had a rally in the Treasury market, I told them to sell or buy inverse ETF instruments to take advantage of that, and they're all making money on that. Okay, very good money. I continue to stick with that view simply because I understand rate setting. It's a function of central bank policy. That is it. In addition, there are other things happening right now. Fiscal expansion in a very significant way. As a matter of fact, we will hit a record amount of U.S. federal government spending this year. It will eclipse the 2009 stimulus year. What I do, the core of my work is analyzing these fiscal flows. And the reason why my work is so far ahead of everybody else is because I get everything in real time from the daily Treasury statement. Whereas 99.9%, we might as well call it 100% of the economics profession looks at backward data, rearward-looking data, data releases from the government that are at best 30 days behind, sometimes a quarter behind. I see everything in real time, day to day. Nobody else does that. So for us, for myself, for my subscribers, it is very, very easy to get a handle on what is going on. The only challenge we face from time to time is having to ride through these periods where the 99% or the 100%, whatever you want to call them, act on their flawed belief about what policy is going to do to the economy. And by the way, speaking of that, and I've been saying this all along, all this trade war stuff, all the tariff fears, I said it's just nonsense. It's nonsense. Net exports are less than 3% of U.S. GDP. And to the extent that the tariffs incentivize more domestic production, we're already seeing it. Capacity utilization ticked up last month. We're seeing steel capacity utilization at the highest level now in 4 years in the United States. To the extent that it incentivizes that, you have more industrial production here in the United States. You see the stock market very close to new all-time record highs, even though yesterday Trump announced tariffs on an additional $200 billion. China retaliated. These are things that a month ago would have sent the market down 400 or 500 points. But guess what? It was up over 200 points today. And the dollar was down. And bonds were down. And copper was up. I mean, these are things that would have been the exact reverse reaction a month ago, 2 months ago, when all the zombies were freaking out about trade wars. And only here and here alone, I was saying, this is all the wrong move. This is like the same move when everyone went crazy with quantitative easing and 0% interest rates, when they thought the dollar was going to go down and there was going to be hyperinflation, and all those goofballs and nut jobs who were screaming that, they were absolutely wrong. In that time period, I was buying the dollar. I was buying treasuries. Everybody was doing the opposite because of their flawed understanding. I am the only one. The only one. And it's going to be proven right again this time. So, sign up for the 30-day free trial of MMT Trader. Go to my website, pitbulleconomics.com. The price is $195 a month. You get it for free for 30 days. You could cancel at any time. Get on the right side of the economics. Get on the right side of understanding the monetary system. Learn some mental game. Develop your mental game. Start making money consistently. Remember, losing is a choice. All of you out there, you choose to lose. You say, oh, let me take a stop loss. Let me lose to win. You cannot lose to win. You have to win. That's what happens here. Bye, everybody.